Welcome to the Deep Dive. Our mission, as always, is simple. Cut through the noise and get you straight to the core insights. Today, we're taking a deep dive into some really fascinating and critical aspects of economic health and policy.
That's right. And for you, our listener, we've really pulled together quite a diverse stack of sources. We've got everything from, believe it or not, a Reddit thread on internal audit practices.
Really? Okay.
Yeah, all the way to academic papers on trade wars, some university insights on corporate governance, information from a leading whistleblower advocacy group. And then, of course, we've layered in recent economic data from respected names like JP Morgan and the Conference Board.
So broad mix.
Exactly. The idea is to try and uncover these interconnected threads, corporate integrity, historical economic lessons, and where the U.S. economy stands right now. Basically giving you a shortcut to being well-informed on these, vital topics.
Okay, so let's unpack this. I think a good place to start is something that honestly always surprises me. How even huge, seemingly successful companies can just collapse, all because of internal financial problems. We're talking about corporate malfeasance, and I guess why strong controls are just so essential.
It's a really stark reminder, isn't it, that size doesn't make you invincible. I mean, look at Enron. This was this massive energy trading giant formed back in 1985, and then boom, 2001, it collapsed spectacularly. At the time, it was the largest corporate bankruptcy in U.S. history. Well, until WorldCom came along just a year later.
Yeah, the Enron story, it really highlights how clever deception can hide these enormous problems. You had executives like Jeffrey Skilling, the CFO, Andrew Fastow. They were exploiting accounting loopholes, right? And that infamous misuse of mark-to-market accounting.
Mark-to-market.
Yeah.
Essentially, it meant they could value long-term contracts and assets at what they expected them to be worth in the future, not what they were actually worth right then.
Okay, and that sounds dangerous.
It is, because if you're booking future uncertain income as current assets, any small shift in reality, any market fluctuation could cause these massive artificial swings in your reported wealth. And Enron definitely inflated these values. It created huge volatility on their financial statements. Plus, they used these things called special purpose entities, or SPEs.
SPEs, right. Those were for hiding debt.
Exactly. Hiding billions in debt and risky assets completely off the main balance sheet. There was even that really notorious case where they misclassified loan transactions as sales. Remember the Merrill Lynch deal with the Nigerian barges?
Vaguely, yeah. It all sounds incredibly shady. And the fallout was massive.
Oh, immense. Shareholders filed a $40 billion lawsuit. The stock price, it went from over $90 a share down to less than $1.
Wow.
And naturally, the SEC launched a full investigation. It's just a classic textbook example of how financial fiction can completely replace reality within a company.
And as you said, came WorldCom, and even larger accounting fraud.
Yeah, larger by the numbers. We're talking about a staggering $11 billion in misstated earnings. But they used a slightly different trick than Enron. Instead of just inflating values, they illegally booked operating expenses as capital expenditures, things like line access fees.
Okay, hold on. That sounds technical. Why is booking an operating expense as a capital expenditure? Why is that such a big deal? Break that down for us.
Right, so think of it like this. WorldCom was paying, say, a monthly fee for network access. That's an operating expense like your rent. It comes out of your profits each month.
Okay, makes sense.
But instead of doing that, instead of reducing their income, they pretended they were buying something permanent, like laying new fiber optic cable. That's a capital expenditure, an investment. By doing that, they made their investments look bigger, their balance sheet stronger, and crucially, their profits looked much, much higher than they really were. It helped them meet those Wall Street expectations.
So it's like me cloning my daily coffee habit is actually an investment in a coffee plantation, just to make my personal finances look better.
That's a pretty good analogy, actually, yes. And what's really striking about the WorldCom case is the role played by the internal audit manager, Cynthia Cooper, and her team. They were the ones who found these irregular prepaid capacity entries, these phantom investments, essentially. They saw funds moving from the income statement to the balance sheet in this weird pattern. And this was despite significant pushback from management, people like David Myers and Scott Sullivan.
So they faced resistance internally.
Absolutely. It really speaks volumes about the kind of pressure and the ethical tightrope people walk inside these organizations sometimes.
So when you step back and look at these scandals, Enron, WorldCom, what's the common thread? I mean, beyond just blaming a few bad actors.
Well, obviously, there's the financial manipulation, overstating profits, hiding liabilities.
Yeah.
But the deeper issue, I think, is often the corrosive influence of weak internal controls. That combined with unethical leadership right at the very top, which naturally brings us to the role of the auditors.
Right. And the failure of the external auditors in some of these cases is, frankly, alarming. Arthur Andersen, who audited Enron, they were accused of having reckless standards. And there was that huge conflict of interest because they were also getting massive consulting fees from Enron.
And they ended up shredding documents.
The
The whole situation led to the firm completely breaking up. And it's not just historical. More recently, you had EY facing criticism for not catching the fraud in the Wirecard scandal in Germany.
So these big audit firms aren't always catching it.
It highlights the importance of having clear rules, which is where GAAP comes in, generally accepted accounting principles. GAAP is issued by FASB, the Financial Accounting Standards Board. They set the rules, and it provides this common framework for consistent, accurate financial reporting. But as Enron demonstrated, even these rules can sometimes be exploited through loopholes if the intent is there.
Which is why you need more than just rules.
Exactly. You need strong corporate governance. That's about accountability, transparency, fairness, responsibility. Good governance builds trust. It leads to repeat business. It ensures long-term viability. Without it, companies are just much more vulnerable.
Okay, so if GAAP provides the rules and auditors are supposed to be the referees, why do we still see so many fouls, so many red cards being missed? Who does actually catch these frauds most effectively?
That's a great question, and the data is pretty clear on this. It's often whistleblowers. They are a critical resource. There was a PwC study back in 2007, maybe a bit dated now, but indicative. It found whistleblowers exposed something like 43% of corporate frauds. Compare that to auditors, who detected only about 19%.
43% versus 19. That's a huge difference.
It really is. It's not just about ethics, it's about sheer efficacy. And that's why laws like Sarbanes-Oxley back in 2002, and especially Dodd-Frank in 2010, were put in place. They aim to protect and actually incentivize whistleblowers.
Right? Dodd-Frank brought in those financial rewards, didn't it? That must be a pretty powerful motivator for someone on the inside.
It can be. Dodd-Frank offers whistleblowers confidentiality, protection against retaliation, and yes, financial rewards, typically 10% to 30% of the money the government recovers from successful prosecutions. These laws are strong. They even allow whistleblowers to take company documents specifically to disclose fraud and to pursue cases in federal court. Federal whistleblower rights can actually supersede confidentiality agreements signed with the company. There was a key case, Erhaft v. Bofi Holdings, that established this.
So it really shifts the power dynamic quite a bit, giving individuals a real tool against corporate wrongdoing.
It aims to, yes, it fundamentally changes the landscape.
And like you mentioned with Wirecard, this isn't just some problem from the 90s or early 2000s. Wirecard happened in 2020, a German payment processor. What was the issue there again? Inflated assets.
Yes, specifically 1.9 billion euros in cash holdings on their balance sheet that simply didn't exist. It was achieved through fictitious transactions. It just underscores that despite all the regulations we've added since Enron and WorldCom, financial misrepresentation is, well, a persistent threat.
It seems the methods might evolve, but the underlying goal, deceiving people through financial misrepresentation, that remains constant.
It does seem that way. And for you, the listener, these failures aren't abstract news stories. They have real, tangible implications. You see a loss of investor confidence that can ripple through the entire market, potential economic instability, misallocation of capital when money flows into fraudulent companies instead of productive ones, and, of course, significant job losses. Imagine working for years, saving for retirement in company stock, only to see it evaporate overnight because of decisions made far above you.
It's a sobering thought. Okay, so we see how these internal deceptions can bring down corporate giants. But what about when the big economic decisions aren't made in the shadows of a boardroom, but out in the open, as national policy? Let's shift gears and look at the broader picture of international trade, specifically tariffs and the risk of trade wars. And there's a really crucial lesson from history here, isn't there? The Smoot-Hawley trade war back in the 1930s.
Yes, Smoot-Hawley, a classic cautionary tale. This was a sweeping U.S. tariff policy adopted in June 1930. It was intended to protect American farmers and industries from foreign competition.
But the intention and the result were quite different.
Drastically different. The immediate consequence was protest from U.S. trade partners, and then very quickly retaliation. They started raising their own tariffs on U.S. imports.
And the impact on U.S. exports was pretty severe, right? The numbers are quite stark.
They are. U.S. exports to countries that protested fell by somewhere between 15% and 22%. But for the countries that actively retaliated with their own tariffs, U.S. exports plunged even more, between 28% and 33%.
Wow. And some countries got really specific in their retaliation, didn't they?
Yes.
Targeting key U.S. goods.
They did. France, for instance, hiked tariffs on major U.S. exports like automobiles and, believe it or not, lard. And you even saw calls for boycotts of prominent American consumer goods, things like cars, again, in places like Argentina, Uruguay, Switzerland. It shows a sort of strategic targeting, almost like a direct economic counterpunch, not just a general tariff increase.
Okay, so it hurt U.S. exports. What about the broader economic impact on the countries that retaliated? You mentioned a decline in welfare. It sounded small, like 0.3 percentage points.
It sounds small, but you have to see it in context. That 0.3 percentage point decline between 1929 and 1930 for those retaliating countries, that represented an 8% reduction in the gains they were getting from trade.
Ah, okay, so an 8% hit to the benefits of trading.
Exactly. And it got worse. By 1931, the welfare decline was about 0.6 percentage points, which was a 17% reduction in their trade gains. So it was a significant bite out of their economic efficiency and overall prosperity.
And there was an interesting lesson there about monetary policy too, right?
Right.
Related to the gold standard.
Yes, the economic takeaway from that period is pretty clear. Countries that stubbornly stayed on the gold standard found themselves more inclined to use trade restrictions like tariffs to try and cope, whereas countries that devalued their currencies, that went off gold, they had more flexibility. They could use monetary policy to stimulate their economies and address the slump, which made them less reliant on protectionism.
Okay, so we have this clear historical precedent. Smoot-Hawley led to retaliation, falling trade, reduced welfare. What does this tell us about today? Are we seeing echoes of this, or have we learned our lesson?
Well, it's complex. We are definitely seeing parallels. Current U.S. trade policy has certainly become more protectionist in recent years. We see tariffs being used more readily, and there's this ongoing trade and, you could say, technology war, particularly with China.
And the motivations feel similar sometimes, protecting domestic industries.
Often, yes. The motivations protecting domestic jobs and industries, they tend to recur throughout history. But the risks also remain incredibly significant. The potential for escalating global trade wars and the very real impact of increased costs for consumers.
And even though the context is different today, we have significant fiscal stimulus. Unlike the 1930s, that temptation for things like Buy America provisions is still there.
It's absolutely still present in policy debates. And for you, the listener, understanding these dynamics is really crucial because protectionist policies, things like tariffs, they directly impact the prices you pay for goods and the stability of supply chains. When the cost of imported goods goes up, whether it's electronics or clothes or building materials, that hits your wallet.
Okay, so that brings us neatly to the present day. Let's pivot and look at the current state of the U.S. economy. Based on the latest data we have, say, as of July 2025, where do things stand? Are we in a recession?
No, the U.S. economy is not currently in a recession. However, the expectation is definitely for slower growth in the second half of this year, 2025. We saw roughly 1% GDP growth in the first half, and the projections are looking like maybe 1.0% in Q3 and slowing further to maybe 0.5% in Q4, so a noticeable slowdown.
And what about the job market? You hear conflicting signals sometimes?
The labor market is softening, I'd say, but it's still remarkably stable, historically speaking. The unemployment rate ticked up slightly to 4.1% in June 2025 from 4.0% back in January, still very low. Monthly payroll additions averaged around 130,000 in the first half of the year, which is decent, but we have seen a notable rise in continuing jobless claims that sometimes foreshadows potentially less hiring activity down the road, so it's something to watch.
Okay. And consumer spending, that's been holding up the economy for a while.
It has held steady, yeah, though maybe at slightly slower growth levels than we saw in 2024. But when we look at inflation, this is where things get interesting, especially with the trade discussion we just had.
How so? What's the latest on inflation?
Well, the Fed's preferred measure, core PCE, personal consumption expenditures inflation, that reached 2.7% in May 2025. So progress towards the Fed's 2% target is being made. However, and this is crucial, the June 2025 CPI report, the Consumer Price Index, seems to indicate that tariffs are already starting to impact consumer prices.
Already. So the effects are showing up now.
It appears so, yeah. Especially in sectors that rely heavily on imports. The forecast is actually that annualized core PCE could potentially spike up towards 4.6% in Q3 because of this.
Wow, 4.6%. That's a big jump from 2.7%.
It is, before hopefully settling back down maybe towards 3.4% by the end of the year. But that tariff impact is a new and potentially disruptive factor in the inflation outlook.
So how is the Federal Reserve navigating this? You've got slowing growth, a softening but still okay labor market, and now this potential tariff-driven inflation bump.
They're being patient. Very data-dependent is the phrase they keep using. Right now, the market expectation and what the Fed seems to be signaling is maybe just one 25 basis point rate cut, likely late in the year, maybe December 2025.
Just one cut.
That's the current thinking. It would bring the federal funds rate range down to 4.00, 4.25% by year end. They might do more cuts in early 2026, but they're clearly in no rush. While this inflation uncertainty, especially with tariffs, is playing out, they want to see sustained progress first.
Okay, let's talk about those leading economic indicators, the LEI from the Conference Board. That often gives a sense of where things might be headed. What did the latest reading show?
Right, the LEI. It actually declined again in June 2025 by 0.3%. That marks a 2.8% decline over the whole first half of the year.
And what's driving that decline?
Well, it's a mixed bag, which makes it interesting. Stock prices actually provided some support. There was a rally, but that was more than offset by other components. Low consumer expectations, weak new orders in manufacturing, and, importantly, rising claims for unemployment insurance. Those have been climbing for 3 months straight now.
And I heard that triggered some kind of signal, a recession signal.
Yes, that's right. Because the LEI's 6-month growth rate and another measure called the diffusion index were both below the threshold level of 50 for the third consecutive month. Historically, that combination has often preceded recessions, so it technically triggered their recession signal.
Okay, a recession signal sounds pretty definitive. Does that mean the Conference Board itself is now forecasting a recession?
Here's the nuance, interestingly, no. Despite their own index flashing this warning signal, the Conference Board is not currently forecasting an actual recession.
How does that work?
They acknowledge the signal points to significant headwinds, but they are projecting more of a substantial economic slowdown for the rest of 2025 rather than a full-blown recession. Think of the LEI like maybe the warning lights on your car's dashboard. When enough lights come on for long enough, it signals potential trouble ahead, even if the engine hasn't completely stalled out just yet. So strong headwinds, yes, but not necessarily an immediate collapse in their view.
Okay, that's a helpful way to think about it. So despite these signals, despite the slowdown, what are the underlying strengths? What makes the U.S. economy resilient?
There are definitely resilience factors. The U.S. economy benefits from a relatively flexible labor market, generally more lax business regulations compared to some other developed economies, very deep and liquid capital markets. Plus, you have global leadership in key tech sectors, and of course, the significant advantage of the dollar being the world's primary reserve currency.
But there are ongoing challenges, too.
Absolutely. Ongoing challenges remain. Things like policy uncertainty, especially around trade and regulation, market volatility, persistent issues like income inequality, and of course the backdrop of growing public debt. It's a complex picture.
It really is. So we've taken quite a journey on this deep dive. We went through the weeds of corporate financial integrity with Enron and WorldCom. We drew lessons from the history books with the Smoot-Hawley trade war. And we've examined the current pulse of the U.S. economy, the slowdown, the inflation dynamics, the LEI signals. It's just so clear how deeply intertwined all these threads are, isn't it? How corporate behavior, policy choices, and economic conditions impact everyone, from big global investors right down to you, the individual consumer.
It really brings it all together, and maybe it leaves us with a bigger question, a thought to mull over. Given that we see these recurring patterns throughout history, the financial manipulation, the protectionist impulses, they seem to pop up again and again despite new rules and regulations. So what deeper factors might be at play? Are there psychological or maybe sociological drivers that make these economic challenges just so persistent across generations? Why do we keep making similar mistakes?
That's a really provocative thought to end on. Something for all of us, and especially for you, our listener, to think about long after this deep dive is over.